Welcome to another edition of CryptoScam. I am your host, Tone Vase, and today we are coming to you from Toronto, Canada. And big thanks to Julia Tourianski of Brave the World for allowing us to do this podcast in her home right here in Toronto with a special guest, Peter Todd, who also happens to live in Toronto. Say hi, Peter.
Yeah, thanks for having me on.
And today we will be talking about Ripple in our 6th episode of CryptoScam. And Peter, why don't you tell the audience a little bit about yourself, though you don't normally need an introduction.
Well, a lot of people know me for my work on Bitcoin Core and research on Bitcoin and so on. But, in addition to that, I also do really what I call applied cryptography consulting, which as I like to say, is what the cool kids call blockchain tech.
Excellent. So today our topic will be Ripple, and we will stick to our usual format where we will just have a little fireside chat of what we think about Ripple, how we see Ripple, and we'll start with the early days of Ripple, the beginning of it, how its current structure and what's currently going on with Ripple, and also the future of Ripple. Now, a slight disclaimer, my knowledge on Ripple is fairly limited. I've never traded Ripple. Ripple started out before my time in the crypto space, and I've been researching Ripple a little bit, and what you're about to find out is the research that I've done just in a one-day span. And you might be surprised how much can be found on Ripple in just one day. So I definitely encourage people to do more due diligence, more of their own research. Don't just take my word for anything from just one day of looking into what Ripple is and how it works. But I wanted to bring that to all of you. All right, so we're going to kick off with the very beginning of Ripple. And this is what I've been learning. And the original founder of Ripple, like the main person involved in Ripple, is Jed McCaleb, and I hope I pronounced that name correctly. And before Ripple, and I think this is very, very important, before Ripple, Jed McCaleb was actually the original creator of MtGox. He started MtGox before Bitcoin. He started it as a Magic the Gathering exchange. And then in 2010, he got interested in Bitcoin as an early Bitcoin adopter, and he decided to bring Bitcoin into MtGox and become the first exchange for Bitcoin. Now, Mark Karpeles at this point is not in the picture at all. This is all Jed McCaleb. Now, in March of 2011, Jed McCaleb is looking to exit his MtGox project, his MtGox company, and he's looking to sell it. He's offering a very reasonable price for MtGox. I don't remember the price off the top of my head, but it's basically he's selling it at a low price, and then whoever buys it will get the profit from MtGox exchange. Mark Karpeles happened to be the person to buy MtGox from Jed McCaleb in March of 2011. Now, this is where it gets really, really interesting, at least to me, in the early days. And what happens is, and this is documented in court files, in April of 2011, so about 1 month after Mark Karpeles purchased the company, there is an email exchange regarding a missing 80,000 Bitcoin, which apparently was hacked or allegedly stolen prior to Mark Karpeles taking over the company. Now, the details on this are very difficult to find. But again, I have done limited research, but it seems like all we know is that 80,000 Bitcoin was missing somewhere in that deal. And there's an email exchange where Jed McCaleb is offering suggestions to Mark Karpeles how to recover the 80,000 Bitcoin, which at the time was worth about 60,000 US dollars. He's suggesting, well, it's only $60,000. You can go and buy them in the open market. But he admits that there are no other exchanges. MtGox is the only exchange. So trying to buy 80,000 Bitcoin at that time is extremely difficult. Like, no one has that kind of Bitcoin to buy. So he then suggests to Mark Karpeles that it's only a problem if the price of Bitcoin goes above $100. So you can slowly buy the Bitcoin with MtGox and no one would really know. So again, this is an unregulated environment. So he's like suggesting to Mark Karpeles all these ways of how he can recover the 80,000 missing Bitcoin. And what happens is the contract of sale from Jed McCaleb to Mark Karpeles was a very, the word I'm looking for. Jed McCaleb was structured the contract. It was very one-sided, so that Mark Karpeles wasn't even able to go to the press or hold McCaleb responsible for that missing 80,000 Bitcoin, according to the contract of sale. So it was very, very strange. So now we're talking, he sold it in March. In April, there was an email exchange regarding this 80,000 missing Bitcoin, which became a big problem because just 6 months later or less, the price of Bitcoin went from under $1 all the way to $30, which made it almost impossible for Mark Karpeles to recover the 80,000 Bitcoin. Now, there was another big problem before the price even hit $30. In June of 2011, there was a hack of MtGox where someone was able to get administrative rights to the MtGox servers. And again, the details on this are fairly opaque. There's not too many details, but speculation has it that it was Jed McCaleb's computer that got hacked for these administrative privileges. And again, it's very difficult to prove if it was hacked or some kind of malicious thing was involved there. But somehow, after the sale of the company, Jed McCaleb still had access to administrative rights to basically MtGox. And those credentials were allegedly used to go into MtGox and orchestrate a flash crash on the MtGox exchange, dropping the price from $14. Now the price, this is in June, the price had just reached $30 and it has fallen down to about $15. And then this hack happens, which drops the price down to 1 penny from $14 in a matter of about an hour or two, creating all kinds of issues.
What allegedly happened with that hack was essentially that the attacker was able to, within the MtGox system, create Bitcoins out of thin air. Bitcoins that didn't actually own to anyone, that weren't actually backed by anything. And when you do that and you sign it to your account, well, the way you go make money off of this is either you withdraw directly, which it sounds like they weren't able to do, or you go sell those Bitcoins, go push down the price, and then go and buy up Bitcoins at a lower price with different accounts. And that gets your money out in ways that are harder to go trace and much more plausibly deniable.
Right, that's also interesting. Now, if you want to connect the dots here, this would be a way for MtGox to recover the 80,000 missing Bitcoins. However, MtGox, when they realized this is a major problem, they actually froze everything and they ended up reversing all the transactions that took place. Yeah. But a fair amount of Bitcoin was still able to get withdrawn during that time. And as we all know, once Bitcoin leaves your exchange, you can't get it back. And it's still a little unclear in the research that I just done, how much Bitcoin was actually lost during that time. And right now, I'm gonna play a video that someone happened to be watching this happening live, tick by tick, and he was able to record it. And this will be in the show notes as well. And So I'm gonna play this for you with audio for the people that are only listening to this, but for people watching this on YouTube, there will be a video of someone recording this entire process, and that person is speculating that there's a serious problem with MtGox and that he's taken all of his Bitcoin out, and this is back in 2011. And then there is a parts of a second video that he did later in the day when he further analyzes the situation. So the next thing you hear will be what was happening live back in 2011, and then we will, me and Peter will come back on and talk about the rest.
Good afternoon, everyone. Time for another Bitcoin report. You are watching a crash in real time. We are down to 4.8, 4.6, 4.5, 4.4. I've been watching this since about 17. I've not seen a single uptick in this market. It's going straight down. I would be fascinated to know what news is associated with this. I'm sure we're going to find out. 3.5, 3.3, 3.2, and 3.1. Well, I'm all broken up about my $99. The main thing I'm broken up about is I could have had 33 Bitcoins. So we're going to see how low this thing goes. We're down to 2.2. And it looks like the MtGox feed crashed. We are still crashing. We're at 2. And this has got to be some kind of news about MtGox. Possibly that it's closed down. I don't know. We're getting feed crashes at this point. We're at 1.5. We're at 1.4. 1.3. Looks like we're going to go under $1 here. This has got to be accompanied by some kind of news. I'm going to wait until the market settles down here and go and look for some news. We are down to 1. And we're trying to go under 1. Notice I have not seen a positive tick. Since this began at 17, every single tick has been flat or negative. Now these are green, but the reds are sells, the greens are buys. Here we go. We're at 91 cents. We're at 90 cents. We are going all the way down. This is wild. We are down to 70 cents, 60 cents. This is the flash crash in Bitcoins. We are down to 50 cents a coin. I cannot imagine what news is accompanying to this. We're at 29 cents. We're off the charts. And here we go. We lost the MtGox feed again. We still have not seen one buy. We're down to 12 cents, 11 cents, 10 cents. Wow, this is it. Feed gone again. We are down to 10 cents. We're down to 9 cents, 6 cents. We are going 5 cents. We are down to... Wow. I don't know what this means, people. We are down to 1 cent. There's still no buying. Could the critics have been correct? Has the system been hacked? I don't know. We are flatlining at 1.2 cent a Bitcoin, and they're selling. People are selling 0.03 Bitcoins for less than 1 cent. I'm not really sure how that is. This is going to be the biggest story ever. And I'm just really glad to be covering this in real time. We are at... Okay, now this is the first rally I've seen. There's a 70 cent tick. And, well, it's not reflected on the chart. Let me see if it's reflected on the 5-minute chart. Looks like a complete washout. Down to 1 cent, they have washed everybody out. And not surprising that our charting is crashing. People, we touched 1 cent. Absolutely incredible. Incredible. Something so huge has happened with the Bitcoin. I don't know what it is, but I will try to find out. Let's jump over to, well, we're just crashing. We can't even keep the system up. Let's jump over to the Bitcoin forum and see if anybody knows anything. Someone's cashing out the motherload on MtGox. Huge sell-off, order not possible on MtGox. Satoshi running with his money. Interesting. Let's see here. And 1 cent. That's right, people. 1 cent. Now we're back up to $1. So this appears, is that $2 and $1? I wish my charting software was working, but it doesn't seem to be working at all. The bad ticks are just coming like crazy. It looks like a complete washout. Now, I haven't studied before to see if MtGox has buy limit orders, lock book buy sell limit orders. So now we're getting $13. This looks like a flash crash. So I don't know what's going on at MtGox. This is just craziness. Okay, our 10 minutes shows us nothing. It looks like our data has completely crashed. We're back up to 14. It looks like we may have had a flash crash on MtGox. Let me kill the feed and restart it. And I'm not seeing any historical data come in. There we go. 14. It's looking like a flash crash, people. Really bizarre. Let me see if I can get into MtGox. MtGox shows the crash. Negative 1.8. That's great. So I guess you owe them money. Fantastic. We're back to $14. This is crazy. I may end up pulling my Bitcoins off of here. My 6.16 Bitcoins. We may be looking at some kind of scam going on. It may not have to do with Bitcoins. It may actually have to do with the MtGox site. So you can see our flash crash in Bitcoins. It looks like we went to 1 cent. So I hope nobody had any limit orders on MtGox, because if you do, they just took all your coins. And that ought to tell you about trading with limit orders and stops, because the way that works is that in a flash crash, and that happened in the May flash crash in the stock market, there were stocks that flashed to a penny and flashed back up. And of course, that's never been sufficiently investigated. So this is an ongoing one, people. I may have to cover this again tonight. But we had a flash crash to 1 penny on MtGox in the Bitcoin. We're back up now to 15. And this is craziness. But I will let you know what I find out. Talk to you next time.
Alright, so here's a quick follow-up video from the same person, the Bitcoin channel, also from June 19th, 2011. So go ahead and have a listen.
Good evening, everyone. Time for another Bitcoin report. Well, we are over at Trade Hill. And Bitcoins are last at 13. 13.5 by 13. So if you haven't heard the news, it's some pretty big news. MtGox got pwned is the only way to describe it. Somehow a hacker got in, and you can see the news here. It's posted. The Bitcoin will be back around 17.5 after we roll back all trades that have happened after the huge Bitcoin sale that happened on June 20th near 3 a.m. One account with lots of coins was compromised, and whoever stole it using a HK-based IP to log in first sold all the coins in there to buy those just after, and then tried to withdraw the coins. $1,000 a day withdrawal limit was active for this account, and the hacker could only get out with $1,000 worth of coins. Apart from this, no account was compromised and nothing was lost. Due to large impact that this had on the Bitcoin market, we'll roll back every trade which happened since the big sale and ensure this account is secure before opening access again. Update regarding leaked information. We will address this issue too and prevent logins from each user's. Linked information includes username, email address, and hash password, which does not allow anyone to get to the actual passwords should it be complex enough. If you used a simple password, you will not be able to log into MtGox until you change your password to something more secure. If you use the same password on different places, it is recommended to change it as soon as possible. Service return. Service will not be back before June 20th, 11 a.m. This may be delayed depending on what is found during the investigation. So, and of course there's a huge thread. Now, what is even more interesting than that, if there could be anything, is that if you jump on over to the Bitcoin forum, you actually have a thread that now has 3,003 views. Let's refresh it just to see how hot this thing is and watch it go away and be banned. So this thread is actually now it's 3,200. It's the file that contains all of the usernames, passwords uploaded by this chick. Now, I did a quick look on Google, and it doesn't look like there it is. So let's do a search here again. And you can see there's 2 links on Google for this address that has this leaked info that was hacked out of MtGox. So I don't know what the laws were that were broken here. It's pretty complex. I think it's the jurisdiction, isn't it in Japan? So really weird stuff going on. Anyway, so this user posted this link, and you download it and you get this file. And you're like, holy cow. There they are. The usernames, the email address, and the password. The ones that are really disconcerting are the ones like number 4, Just Digi. He doesn't have an email address associated with his password. How is he going to get back in? Now, some have speculated on those threads that they're not sure how strong this hashing is. So basically, and I'm not an expert. I mean, I'm a network guy in computers, but I'm not a systems guy. So I don't know brute force very well, but I'm assuming that someone could try to brute force these. They have every password in hash. They could try to brute force them. It's kind of interesting that they all start with $1. A huge number do. So, now, to find out if this was legit, of course, first thing I did is a Control F and find Brother John F. And guess what? There I am. Number 43,540. And you can see my email address at Yahoo. So, maybe that my $99 experiment Boy, I don't even want to hear Raw Dog go off on this, but my $99 experiment with MtGox may have turned bad. Trust me, I've lost a lot more money than $99 trading futures and options and stocks. But now I do have the raw file of my original video that I posted that was live feed as it was crashing. And when I was watching the live feed, as I rewatched it, there were some interesting things that came out. So let me see if I can revisit it. I actually had another live one that I did, and I tried to save all these. So I'm going to see if I have that one live in the original Cam Studio quality, because there were some interesting things on that crash.
Good afternoon, everyone. Time for another Bitcoin report. You are watching a crash in real time.
Yeah, and this is the original.
We are down to 4.8, 4.6, 4.5.
So
4.
let me
4. I've been watching this
put the
since
volume
about 17.
down.
I've not seen a single uptick in this market. It's going straight down,
and
I would be fascinated.
I'm going
to
try
know
to
what
fast
news is
forward to a
associated
couple
with
of
this. I'm
things
sure we're
before I
gonna
run
find
out of time.
3.5.
This is
3.3.
a 15-minute account, and I don't have, not like my silver channel, I don't have the ability to go above 15 minutes, so I have to cut it short in a couple minutes here, but I wanted to look at this real quick. Now, if you look at this link, at this screenshot here, you can see that the trade that happened at 3:15 was, we went down to 0.0123457, and it was 0.01 coins that were traded. So this was some kind of flash crash. You can see that it was 0.01 coins that were traded at the point of a price of 0.0123457, and they traded at that price for quite a while. Now, if I go farther in the video, I actually brought back up the feed, and you can see where it comes back out of that price. Fortunately, I switched back. I don't know why I didn't leave that live on the screen. I just wasn't thinking at the time. But I'm pretty sure I caught that live of when it came back out. And I have to go back a little bit. And I think that's it. So if you look at these prices in this feed, we had 0.01, and you saw 1,000, then 895, then 1,000, then 10,000, then 100, and then you had 261,000 Bitcoins traded at a penny, and then the price jumped to 7 cents, and then 10 cents, and then $10. So I'm going to have to go back and analyze my feed and my video. I had another video that I did when the price was higher, and I panicked and stopped processing that one and jumped in and ran another video. So hopefully I'm going to get a chance to post everything that I had that occurred while this was happening.
All right, so a big takeaway from this, or probably the biggest takeaway as I've learned as I found this recently, is that over 100,000 Bitcoins did trade at a price of 1 penny, and the statement put out by MtGox and Mark Karpeles stated that only $1,000 worth of Bitcoin was able to be withdrawn before there was a fail-safe, and it limited the withdrawal to $1,000. But what it doesn't say is what the price of Bitcoin was along with that $1,000, right? So this flash crash occurred from a price of around $15 per Bitcoin down to a penny. So was the $1,000 worth of Bitcoin that was withdrawn, was it at $15 a Bitcoin, or was it at 1 penny per Bitcoin? And that's a giant difference. And this doesn't say, perhaps the court case of MtGox, perhaps those documents will shed more light on this. I have not looked into this further. It was 4 to 5 years ago. Oh, wow. Almost 6 years ago now. And so that is another very interesting situation that took place. So perhaps we can ask Mark Arpellis. Maybe he'd be able to shine light, or he may not because of the impending case still going on. But that is that is something of a concern. And the reason why we bring up the history of MtGox is because, as I just learned, Jed McCaleb seems to be quasi-involved or allegedly involved, or at least I think he's allegedly involved in a lot of this MtGox mess. And I think that's very, very relevant to the discussion me and Peter Todd are having with about Ripple. And so right now, let's go ahead and get back to that discussion, and we'll pick up where me and Peter Todd left off. All right, so now that we're back, now that you've seen the video of what actually happened back in 2011, we need to talk about why this is important. This is very important to me because I personally find the origins and the people involved and how those people think and act as important to the trust and the community respect of your projects in the crypto space. But that is the very original history of Jeb McCaleb, and it only took me 1 day to dig all this up. So imagine what we can dig up if you actually start looking into this as an investigative reporter. Okay, so now Jeb McCaleb has wiped his hands of MtGox. Go ahead.
As a developer of a decentralized cryptocurrency, my viewpoint is the creator's story should be totally irrelevant. You should be designing software where who the creator is or what the background is doesn't matter. The truth of the system should be self-evident, which, as we'll get to later, isn't true in Ripple. But
right, and this is a very different perspective because, like Peter just said, to him, the creator shouldn't matter, but to me it does. And if we do get back to Satoshi being anonymous, that's fine. But we can see the way he's acted being anonymous, I find that very respectable, as opposed to what happened in the early days of MtGox before Mark Arpellis. I don't respect some of the things, and we're going to get to some more of that right now.
And again, Satoshi created a system where who he is just of historical interest. Had Satoshi created, say, an e-gold system with a central server, who Satoshi was would be very relevant and very important. And if you couldn't find that out and know his background, there's no reason to trust it. Fortunately, Bitcoin isn't that type of system.
Very true. All right, so let's move on again with the early days of Ripple, even though so far I've been talking about Bitcoin, but to me it's relevant because after Jeb McCaleb completely washed his hands from all things MtGox, he got together with Arthur Brito and David Schwartz, who I believe also worked with him on a previous project, but this statement does need to be fact-checked. And they began working on a private blockchain because they saw a lot of issues in this decentralized Bitcoin model. And they figured they would do more of a centralized version of Bitcoin. A little later, go ahead.
Although, what they were actually thinking is a little hard to go say, because if you ask the Ripple people whether or not Ripple is a centralized system, they're going to say no.
They probably will.
And I think they'd be more likely to say, especially back at that time, that it was public. And after all, Ripple itself, it actually came from an even earlier system, which I think we'll get into.
We're going to get to in one second. Right. So, Jeb McCaleb got together with a few people that he knew as developers, and they were joined by Chris Larson in 2012. And Chris Larson came from projects like Elon and Prosper. I'm not too familiar with these projects, but I guess he had a name in the space. in doing some kind of digital payments, digital e-loans. That's kind of self-explanatory. So they got together in 2012, and that's when they approached Ripple, or Ripple Pay as it was known, and that project was Ryan Fugger. Was the person that's been working on Ripple since 2004. So Ripple is much older than Bitcoin, and I'm not sure what it was back in 2004 up until 2012, but it was some kind of a payment system, a centralized payment system, like a better version of PayPal, or do you have any more details
this is
on
actually
that?
an interesting thing. So the original Ripple was a very interesting system where, for instance, if you and I were using Ripple, just by ourselves using Ripple, all we'd be doing is essentially just keeping track of what credits and debits we owe between each other. Where Ripple, the original Ripple, was interesting is that in a network, well, if you're connected to, say, someone who's connected to my barber, for instance, I could go and send money to that barber to go pay for a haircut via giving money to you, and you'll give money to your buddy, and so on. And you can actually create these networks of credit, not unlike, say, Hawala, for instance. But what's very interesting about these kind of networks is that doesn't have to be in global consensus. If you're not in that path from me to, say, my barber, someone from, say, me to the guy I'm selling my house to, they don't need to know what I just paid. That's completely irrelevant to them. It's only, the consensus is only between individuals in the system. And that means the system scales really well. And it's also truly decentralized. Now, this isn't the same trust model as, say, Bitcoin, because it's person-to-person trust. But in theory, if you can actually create the system and, get enough people interested in it, it does work. And again, we see this in Hawala. In a way, Ripple is Hawala with much better accounting.
Well, it was supposed to be.
Yes. Ripple was supposed to be Hawala with better accounting. And as we'll see, Ripple Labs, they went and changed it all. They made it into a centralized system for interesting reasons.
Which we'll get to that in a minute. So basically, Jeb McCaleb and Chris Larson approached Ryan Fugger and tried to convince him that Ripple needs to be a little more like Bitcoin, and it needs its own inherent token with a speculative value.
Yeah.
So a digital token. And that, I guess they did a really good job on convincing him. And that gave us the XRP token from a system that was originally designed to do something different.
I mean, essentially, Ripple as we know it today, what I often call Ripple Labs Ripple, they went and bought the name Ripple from the original creator. Ripple, as we know it now, has very little, if anything, to do with the original Ripple, other than that very lovely name.
And I do encourage people to go to archive.org. And you can take a look at what that website looked like pre-Bitcoin. So you can definitely Google that. I'll try to post a link in the show notes. But otherwise, the history of Ripple.com is there on archive.org. Okay, so now Ripple Labs forms. I think there's another company. Is it Open something, but that's not
so many
there's just a lot of names, just corporations. And so they decide to have XRP, and the way they decided to release XRP was they would create all of the Ripple tokens in one shot. You want to call it a pre-mine, but there was no mining ever going to take place, so it's just an initial creation of the tokens.
It's a definitional thing. It's like in Bitcoin, we said that the Genesis block was, a block with such and such a hash. In Ripple, it's like you said, the Genesis block is this block. But by the way, the very definition of the Genesis block is to create 100 billion Ripple out of thin air.
Right.
And the next thing we do with that is then we distribute that Ripple.
Right. So they created 100 billion Ripple tokens in their Genesis block, and that was going to be all the Ripple tokens that are supposedly will ever be created, but there's no mathematic formula that keeps it that way. So it's just an arbitrary statement that we will only have 100 billion Ripple.
there's a protocol formula in the sense that if the protocol doesn't allow Ripple to be counterfeited, and there is no other mechanism to create Ripple, that 100 billion should be the only Ripple that exists.
Okay.
So I would say it's every bit as strong as Bitcoin.
Without a consensus mechanism,
that's
can be changed.
Where it's another matter. But,
right.
It's not unlike Bitcoin in that sense.
All right, but we'll assume that they will stick to the community promise of only creating 100 billion Ripple, even though it's a lot easier to change that number in the future than in something like Bitcoin.
And indeed, changing it may be irrelevant. I mean, if there's a billion Ripple in circulation and 99 billion Ripple are elsewhere, that's essentially an exhaustible supply to inflate the currency from the perspective of the market. Inflation, after all, isn't about the number. It's about supply and demand.
Agreed. That is true. Okay, so we have 100 billion Ripple tokens created, and initially, the 20% of it got held directly by the co-founders, including Jed McCaleb and some others. They got to hold on to 20%. The other 80% was fully controlled by Ripple Labs. However, Ripple Labs did release a fair chunk of those coins into open circulation for people to trade it and use it, even though at the time there wasn't really much of a use case, in order to get a market price, kind of like an initial coin offering that we're seeing today, and Ethereum kind of kicked that off. So this might have been like the very first one that did something like this. This definitely came earlier than Ethereum. So they released a fraction of that 80% into circulation. Now this is where it becomes, again, more research needs to be done of how much was actually released, because this isn't very well documented. And it's a little hard to get your hands on the numbers. And for example, the Brave New Coin index of altcoins lists Ripple with a market cap using just under 100 billion Ripple tokens. Meanwhile, Crypto Market Cap is only using Bitcoin in circulation, I would assume. So their market cap of Ripple, XRP in circulation. Yeah. So the number of coins outstanding, if you look at coin market cap, is it's just under 37 billion coins. So there's really no consensus on how to even judge the market cap of Ripple. Are you using the Ripples in circulation, or are you using the 100 billion Ripple that have already been created?
And I'll point out, this is essentially a common scam in altcoins, where you'll create a currency where the actual units, the actual tokens in circulation are a very small number. And you create an artificially high market cap by having a much larger amount of tokens that are not actively in circulation. An example being, I could create Todd coin. And I could say, well, Todd coin, there's 100 trillion Todd coins out there. And then I'll release one single Todd coin out in circulation. Right. I'll get a friend of mine to go buy it for $1,000.
Right, and adjust the market cap. Everything. Well, this is ludicrous. Well, again, this is what happened with Steemit in the very beginning, because in Steemit, 98 or 99% was all in steam power that you needed 2 years to power down fully, and there was less than probably 1 to 2% of Steemit in circulation. So once it hits the news and demand comes, you have a very constricted supply. And Zcash had something similar when they started to release Zcash at fractions at a point at a time.
Well, Zcash was somewhat of a different thing in that the actual amount in circulation was very small.
The demand
was very high.
Exactly.
And it's not like there existed Zcash out there.
That's true.
That at the time there simply didn't exist much.
That is absolutely true.
Dash, however, is a good example of this phenomenon, where in Dash they created this masternodes concept. And the masternodes thing was essentially a glorified CoinJoin implementation.
Right.
Bitcoin could go do it, but the beauty of masternodes was in the protocol. You had to go type a pile of Dash. So you have this great excuse to keep Dash out of circulation.
And we have mentioned this because I've already done a CryptoScam Dash episode where we talked about this, where the masternodes have removed a lot of the Dash from circulation, keeping the tradable Dash at a contracted supply. Not to mention the master nodes also create like it's now half proof of stake, which benefits the early adopters. But please go back to the Dash episode, which was episode 4, and please check that out for more on that.
So I'd point out, I mean, the bigger issue with this, and like I personally, I see no issue with creating a coin in creating all the coins that will ever exist, in block number 0. That's not necessarily a bad thing to do, and there's sometimes technical reasons to do it. But the thing with Ripple, though, is we started out with a system that didn't have global consensus, didn't need it. And by creating a coin, suddenly you need global consensus. Suddenly you need to radically change this architecture that previously was actually kind of beautiful to an architecture that looks like a regular blockchain. And that's really where we'll see later where these issues kind of come out with Ripple, precisely because they created this coin. Now, if I were in their position, well, why would I go create the coin? Well, I mean, who wouldn't want to own 20% of the coin?
Of course.
Like, it's a good way to make a lot of money, and that creates very skewed technical and social and economic incentives that aren't necessarily aligned with what's good tech.
All right, so let's get back to the Ripple token and So the idea, from what I understand it, and again, my knowledge of Ripple is fairly limited because I was never a fan of it from the beginning, from even my very basic knowledge, is that now that there is 100 billion Ripple tokens, the token itself would be used for anti-spam prevention, so that when you do a financial transaction between banks or people, you would burn the Ripple tokens out of existence in order to prevent spam. So every time you use...
well, I mean, let's explain this a little more clearly. This spam thing is a fee. It's a transaction fee.
Yeah.
And given that the holders of Ripple are Ripple Labs and the founders, the transaction fees ultimately go right to the founders, in Ripple Labs. Because that's taking the supply of Ripple out. And for the price to stay stable, that allows them to go sell. Simple as that.
Right. So basically, since they control the majority of them, as people burn these coins, the coins that they hold on to slowly become more and more valuable. Yeah. And the idea was to Ripple Labs to initially be the faucet for all these tokens, while making the founders richer and richer over time, like what happened with Mark Zuckerberg for having, a large chunk of Facebook before going public.
It's just a roundabout way of having a transaction fee. I mean, PayPal does this too. PayPal transactions, some of them are free for marketing reasons, but most of them will cost money to do. And that's a transaction fee. The money goes to PayPal, it pays expenses. Yeah. That's exactly what Ripple's doing too. Really no different. It's just a different way of implementing the transaction fee. And it lets you kind of create roundabout arguments, but it is a transaction fee. Much in the same way as inflation is a tax on saving. And if you go talk to an honest economist, they'll say, that's exactly what it is, and sometimes we have good arguments for that. You may disagree, but that's the argument for it, and it's a tax.
Well, I actually agree with that. All right, so now we've generally gone over like what the Ripple token XRP is, and what that Ripple token does. Now, at one point, there was supposed to be a consumer wallet where people hold on to these Ripple tokens. I believe that project was scrapped. It never got anywhere. I don't have any details on that wallet.
Have used
I don't know
actually,
if you
or at least I think I've used what you're talking about there. And it's very, very bare bones. I mean, you couldn't really do much with it. But you can go trade your Ripple around and trade it to and from Bitcoin. Of course, that's a great way to create a market.
And one last point on the beginnings of Ripple. In 2015, and possibly even prior to that, but again, I haven't done all the research necessary for this, there was a major SEC action, and there was a FinCEN action, I believe, prior to that, where... or it might have been FinCEN. I'm sorry. I need to double check on that. Where Ripple Labs got fined $700,000 over some of the contracts that they had. I believe Roger Ver was even involved, maybe?
Yeah. I mean,
or was that a different project?
That may be true, but I think just the big summary there was essentially the SEC and FinCEN took one look at it and said, well, obviously you're creating an offering of some kind out of thin air. There's a zillion rules that goes and violates. You're not doing AML KYC on this. Pretty easy to go nail them for that.
Right, and that had a lot of ramifications because they did force Ripple Labs to change their model in order to add KYC into the equation, creating these trusted entry points. In addition, there was this whole thing, again, with this action because of Jeb McKenna, who decided to leave the project now that he started MtGox and sold it to Mark Karpeles with questionable terms. He then decided to leave Ripple in order to clone Ripple to create Stellar.
Yeah.
And we're not going to get into Stellar on this episode. I will probably get into Stellar in a future episode. But at this point, the founder of MtGox and then pretty much the founder of the Ripple as we know it today has now moved on to a third project, which is just as questionable as the first two. And he's now in what I like to call Daniel Larimer land, moving on to his third project that is probably going to end up no different than the first two. And during that whole process, he then decided to sell a portion of his ownership stake, part of that 20%. That caused a big problem and more lawsuits where Ripple Labs now attempted to prevent him from selling that stake. So they were able to freeze his own ownership of Ripple, which again goes to show you how centralized the system is. And then somehow there is a lawsuit involving Bitstamp or Kraken, where he was trying to sell them from. So now other exchanges ended up getting involved in this entire mess of him looking to exit the stake. And I believe it went to the courts. And I don't really know how it ended. But the whole thing is just very, very sketchy.
Around that time, that's when R3 actually, initially hired me to go and do consulting work with them. And it was kind of an interesting time because R3 was looking at essentially all the blockchain tech out there. What could they go and partner with? What could they buy? Whatever to bring blockchain tech to the banks. And of course, they're not just going to buy something at random. Right. They want due diligence. So the first project I did for R3 was due diligence on Ripple.
Okay, so can we, since we're jumping on, so let's stick with that, right? So what was R3 Seb's interest in Ripple that led you to do the investigation? What were they thinking?
My understanding is they may have gone and bought them, or partnered with them or something. It's not, like partnered with Ripple Labs, bought Ripple Labs. I'm not totally sure, but essentially I was asked, could you evaluate this tech? Is this actually suitable for banks and so on? And I was one of two people on the group doing that. I looked at it from really solidly the tech side. The other person in that project looked at it more from the business side. And that other person, Jo Lang, she did a lot of research into, what was the issue with XRP, who owned it, what the rules were, and so on. And it's interesting reading her report because she brought up a lot of things like, who owns XRP, what AML KYC rules there are, all this stuff. I, on the other hand, focused really on the consensus algorithm. How does Ripple actually work under the hood? And like I said before, to have XRP, to have a coin, you need global consensus. And since you need global consensus, well, now you got to introduce something to make global consensus into the system. They weren't going to do Bitcoin. They weren't going to do proof of work. They weren't going to tie it to Bitcoin or, piggyback off another global consensus. So instead, they used something that's, long story short, looks like a standard, practical Byzantine fault-tolerant system, where you have nodes that decide what the consensus is. And what's the interesting thing about it is their sort of play on this to say that it's a distributed or decentralized system was to say that every user of Ripple who was running a node would have what's called the unique nodes list. And that is the unique nodes list would be the nodes that they think are unique. That would then, be the trustworthy things that not be civil attacked and so on.
So let's get into that some more. Okay, so right now, and I want to talk about the Ripple Protocol Consensus Algorithm Review, which you wrote, Peter, on May 11th, 2015. Yeah. So let's just go through this paper and some of the parts in this paper, and you can be a little more specific. And I have some parts from every single section of it. So some parts that caught my eye as I read over your paper. So in the overall architecture, the following caught my eye. And I will read it out because not everyone's watching the YouTube for the podcast audio audience. So additionally, a native currency XRP has been added, which is used for anti-spam transaction fees and to serve as universal currency. And we've discussed this already on this podcast, and you've noticed this right away that it was added, but you were kind of questioning why it was done in that way.
Well, and I'll point out, that paper, I soft pedaled it. I wasn't going to just put it right in the paper, hey, I think this is giant scam. I was going to go and put the nicest possible spin on this. And I didn't need to go beyond that. I could give them all the benefit of the doubt, and I think the paper still showed it wasn't necessarily a good idea.
All right, so here's the next section. This is from section 3, their global ledger. Yeah. And in this section, the following caught my eye. The blockchain doesn't itself deal directly with the consensus protocol. Rather, validators sign messages as part of the consensus protocol. And knowledge of those messages lets Ripple nodes determine the correct chain. Detailed documentation about exactly how the ledger is structured is spotty.
Yeah. Well, my impression when I wrote that was that Ripple Labs didn't really want to go say that Ripple had a blockchain. They wanted to present it as much closer to the original Ripple idea. So, nowhere in their technical documentation did they actually, as I recall, say that they had a blockchain. You really had to dig down the code to realize this. And secondly, once you do dig it down into the code, their blockchain was just a chain of blocks. Within the blockchain itself, there is no idea of what consensus is. Literally is block number, 100 points to block number 99, which points to 98. And nothing in that data structure says why that block should be different than, say, a different version of block number 100. Where that comes out about is the signed messages that validator nodes pass around. But why should you why would you trust a signed message? It's just a message. I can go create 1 million signed messages. Why you trust them is because they correspond to your unique node list. Well, hang on a second. If that's a unique node list, doesn't that sound like a centralized system?
Right. Well, let's get on that because section 4 of your paper talks about the consensus algorithm. And I'll read an expert from here, and maybe you can add additional commentary, even though you've already mentioned it. So this is the unique node list, known as UNL. So anything going forward, when you hear UNL, it refers to the unique node list. Okay, so here we go. Like the vast majority of consensus algorithms, the Ripple consensus algorithm starts with a known set of nodes known to be participating in the consensus. This unique node list, UNL for short, is a list of public keys meant to be associated with active validating nodes the node operator believes are unique. Ripple Labs suggests that UNLs, the unique node lists, should have 100 plus nodes on them and provides a starter UNL with 5 to 8 nodes. That seems kind of crazy. With only 5 to 8?
Well, the very fact that there is a number of them is the crazy bit. Like,
they're suggesting 100 plus, but they're starting you off with
Well, I mean, from what I could see, like, nobody was volunteering to run a UNL.
And we'll get to that soon also, and as to why that is.
Yeah.
Yeah. So that was their initial suggestion. So here's another part from the same section. Different nodes may choose to use different UNLs. If the UNL, the unique node list, do not sufficiently overlap global consensus, is not guaranteed because different UNL clicks can come to consensus independently of each other. For instance, Figure 4 shows a simple example with two UNL clicks, red and blue, that have forked because of insufficient connectivity, resulting in the forked blockchain shown in Figure 5. More complex figure models also have been identified, such as the less than majority evil, failure mode identified by Gregory Maxwell, and separate supermajority models identified by Andrew Miller. So these are very high-profile people that understand blockchains.
Oh, yeah.
That immediately saw issues with this unique
honestly,
node list.
anyone who is familiar with how consensus algorithms work would notice this. And in fact, my paper, the way I structured my paper was say, all right, let's assume that everything Ripple is saying about their consensus algorithm is true. Let's assume that there are no issues with the underlying algorithm. Let's go look at what assumptions it makes. And the big assumption is that you have a unique node list. And the reason why they can go fork is just dead simple. If you have a different unique node list than me, or they don't overlap sufficiently, the nodes that you think are unique may go vote one way. The nodes I think are unique may vote the other way. And they're just different groups of people. It's like asking, why would the Canadian election and the American election vote for different presidents? Well, I mean, the answer to that is just so obvious, we don't even call them presidents. Here in Canada, we call prime ministers. It's a separate set of people. And there may be overlap, but unless you guarantee that overlap, there's no guarantee that they'll come to the same conclusion. And Ripple, on a tech level, has no mechanism to guarantee overlap. In comparison, in Bitcoin, you have economic incentives. Miners are economically incentivized to join all other miners. And equally, a miner can join the system without permission. From the point of view of you being a validating node operator, if you try to run a validating node, my unique node list will never include your node. You have to essentially ask me permission to put into that list. You don't automatically get into that list. And there's no sane mechanism to go do that. In Bitcoin, there's a sane mechanism because of proof of work. In Ripple, there is no mechanism to do that. It's just, I don't know, somehow you get to the same UNL list. I mean, it's completely undefined.
All right, so let's continue on. We're still sticking with the consensus algorithm because that's the most important part.
Yep.
The consensus. So here's another expert from section 4 on consensus. The source code doesn't appear to have any provisions for reorganizations of the ledger when a ledger fork is detected.
And it's easy to understand why it wouldn't be written that way. It's a new unique node list. From the perspective of you and your unique node list, there should never be a reorganization. If you make the assumption that they're not going to sign two different versions of history, two different consensuses, there is no way for reorganization to happen. So under that assumption, it's totally reasonable not to actually include the code to fix that problem. In Bitcoin, we know we will have this problem. It's guaranteed in the protocol. It doesn't happen that often, but you will periodically get small reorgs and sometimes bigger ones. It's just, it's part and parcel of having a system that can handle global consensus in a way that's decentralized. The fact that Ripple leaves it out is a very strong suggestion. This isn't actually a decentralized system.
All right, so sticking with this, read a little more from the paper. Regardless, it is certain that following a fork caused by disjoint UNL clicks, am I pronouncing that word right?
Cliques.
Cliques?
I always forget it myself.
And you wrote it, but it's very well sounding.
It wasn't part of a clique.
Yeah. Regardless, so let me just read that again. Regardless, it is certain that following a fork caused by disjoint UNL clicks, the losing side simply has to discard some or all history, possibly resulting in double spend and associated financial losses. And that sounds like a problem for a non-technical person.
Here's an easy way to understand this. Imagine if you are on separate sides of the world, and right down the middle of the world, all the internet cables break. Now, obviously, there is no mechanism for data to get from one side of the world to the other. It can't happen. The internet cables are down. Well, that means that the UNL on one side and the UNL on the other side can come to a different consensus, provided that they don't overlap. And since that can happen, well, I, being the malicious guy, I could take advantage of this. I could sell my house twice on Ripple. Well, I'll go, sell it once to you on one side of the world, and I'll sell it once to another person on the other side of the world.
And isn't this also one of the concerns with Bitcoin if we go to larger blocks because of the Chinese firewall? That would make it difficult to move a large block out or into China, and we can have a split in the Bitcoin network because of the propagation of a large block and moving through a Chinese firewall.
That issue is a little more subtle in that, in that circumstance, Bitcoin provides mechanisms to still come to consensus. It's that sort of thing's expected to happen. It's rather more that someone outside of China, in that example, is now at a disadvantage because the guys in the Chinese firewall, they have fast internet connectivity, and the people outside are always lagging behind. Ripple, on the other hand, in that kind of scenario, the people inside and the people outside, their software is making the assumption that's just not possible.
That's a terrible assumption.
Yeah, there is no getting around it. If I go sell the same house twice on different UNL cliques, somebody's got to lose out. There is only one house, and I can't sell it twice. Yeah. And someone's transactions are going to get canceled.
All right, so let's conclude Section 4 on consensus with the following. In every circumstance, node operators can reduce the risk of losses due to consensus failures by removing non-default UNL entries, with the least risky option being to simply stick with the default UNL of 100% Ripple Labs controlled nodes. This is particularly acute given the low profit margins of many financial transactions. While a denial of service halts incoming revenue, a double spend attack can quickly drain working capital, quite possibly without any hope of ever recovering the stolen funds.
And now, to Ripple's credit, if you and I are on the same UNL, there's only two possibilities, assuming, of course, the UNL nodes are being honest, working properly. Either consensus halts and stops advancing, or it continues in transaction process. You'll never get a double spend. Well, all I'm saying there in that paragraph is how do you maximize that probability? Suppose I'm a sysadmin at a bank. I know that you, sysadmin at a different bank, are probably going to be using a UNL provided by Ripple Labs. So I might as well make sure I use the same one. Because if I use the same one as you, it's always going to be in consensus. Therefore, consensus gets controlled by Ripple.
And it's to everyone's advantage to use the same UNL.
Yep.
Right. And here is the very final paragraph from the consensus section. A closely related issue is what incentives does a node operator have to publicly perform validation services. Ripple currently has no compensation mechanism for public validators, yet validation at minimum raises potential legal issues such as lawsuits for negligence or aiding financial crimes. Again, the least risk option is to not publicly validate the Ripple ledger. So the way I read this, you want to outsource all your legal liability onto Ripple Labs and have them deal with it.
Yeah,
and they've been dealing with it to the tune of $700,000 due to regulatory fines in 2015,
And
even before any of this.
That statement is just very simple. Well, in my example of you and I being different banks, the moment we make our validation nodes public, the moment we try to sign what we think the consensus is, we might screw that up. And screwing it up can mean people lose money, a lot of money. Well, why would I even begin to take that risk? Why don't I just let Ripple do it? Why don't I let them take on the risk? Sure, in theory, maybe it's more reliable if people participate in the consensus, but there is no incentive for me to do that, other than maybe vague notions of reputation or something. Within the system, there's just no feedback loop there. There's no reason to do it. This isn't like Bitcoin where you earn money mining. All you do is you take on risk, and you don't actually make the system any more reliable because there's no in-protocol mechanism to come to consensus on what the UNL should be.
Right. That's very good points. Very good points. All right. Let's move on to section 5, and this is the attack scenarios. And this is the bread and butter. The consensus is obviously an issue, but putting the consensus aside, so assuming they don't have a consensus problem, what kind of attack vectors are we potentially dealing with? But a lot of them are depending on that consensus.
Yeah, this was more like what type of consensus failures could happen and what are the costs of there.
All right, so here's some parts that I found very interesting in reading through this. A closely related issue with attempting to predict monetary losses is that at some point losses can be sufficiently high that they create situations where social consensus can decide that the losses simply must be reversed. For instance, Vericoin community chose to do a hard fork of their old currency to undo the impact of a major theft.
Yeah, I actually had a spelling mistake there. I think I misspelled metallic, and I somehow said Vericoin community.
So if you were to redo this paper today, Vericoin would have said metallic.
Yeah, well, Vericoin said Ethereum.
Yeah, Ethereum. But you wrote this before the Ethereum fork. But otherwise, Ethereum would have been a much more known example. A lot of people might not be familiar with Vericoin. Perhaps this podcast will get to Vericoin way down the line, but I highly doubt it.
In fact, I'd totally forgotten about Vericoin myself.
Until you were just reminded.
Until I just saw that.
That was the best example you had at the time, but obviously now you would have a much better example.
Thanks, Vitalik.
Yes. No, I used that as an example many times. All right, so let's stick with attack vectors. And there you have a couple of other very good points that I found very interesting. The Ripple protocol itself is extremely complex with many different types of transactions, and all functionality being implemented directly in the protocol itself.
Yeah. And when I say all functionality being implemented directly, I mean, if you looked at the Ripple daemon, the actual Ripple node software, well, if you want to do a loan on Ripple, somewhere in that software it's going to have to know what a loan is and all the characteristics of a loan, and that's how everything in Ripple was written. There was no VM layer like Ethereum had, which would have actually been a very big improvement just to be able to abstract away that type of issue. But that also raises legal issues because, as we saw with the FTC action, Ripple being unable to police their own network puts them at risk. And it sounds like the feds have essentially said, well, you have to be able to police what happens. And one of the few ways of really policing that is to put all the consensus under their control. Putting it right into the code base is an easy way to do it.
And then you also mention improvements to Ripple frequently require changing the consensus critical code base rather than user software.
Yeah, same issue. I mean, the example I gave was multisig, where Ripple at the time just didn't have the concept of multisig. And because there's no scripts, the only way to implement it was to change the core consensus and do, a hard fork of the Ripple protocol and actually add that in. Well, of course, when you add that in, everyone has to update that at the same time or it falls out of consensus. And if one person's writing a little different version of Ripple than the other, it can still fall out of consensus. So one of my threat models there was just can Ripple fall out of consensus accidentally? And the answer is yes, absolutely. And with different UNL lists, falling out of consensus can lead directly to losses.
All right, so let's move on with the paper. Again, we're sticking to attack vectors of Section 5. The attacker creates large numbers of transactions, either covertly or overtly, until the Ripple network fails due to overload, or more likely, Ripple users are priced out of their ability to use the Ripple network. Transactions pay a minimum fee per transaction by destroying XRP. The fee per transaction is set by a vote between all the validators on the UNL list. And one bullet point, Ripple Labs plans to require verified user identification to use the Ripple network in the near future, probably because of that.
For a lot of reasons. But, it's interesting. The user verification is definitely a mitigating factor there. But the issue I was really getting at is that, like Bitcoin, because Ripple is based on a blockchain that everyone who's validating has a copy of and needs to have a copy of, Ripple doesn't scale. So if I want to crash the Ripple network, I can just go and pay transaction fees to push up the cost of Ripple transactions, just like you can do on Bitcoin. And there's a lot of different manipulations I can do there. One is I can go force smaller nodes out of the Ripple network. I can make it that even if they are on someone's UNL set, those nodes fail. I can do it structurally to go and say push them out of long term or in the short term. And of course, I just price people out of the ability to use Ripple. And, this is just a given. I mean, when I discuss this with big banks, like one of their issues was, hang on a second, like, you mean if I'm using Ripple and I want to run a node, I have to go process transactions around the world that have nothing to do with me at all? The original Ripple idea, that wasn't true. Original Ripple actually scaled really well. Ripple Labs Ripple doesn't.
All right, so let's jump into coercion of validators. And this I found very critical in your statement, where you say the Ripple node implementation does not check full history. This means if validators sign an invalid ledger, the transactions that make it invalid can be hidden from Ripple users.
Yep. I mean, and it's quite a simple problem. Like, when you start up a Ripple node for the first time, it just doesn't download old history. It assumes that what the Ripple validator signed is correct, which means that, by hook or by crook or whatever, if I force people on your UNL set to create an invalid block, say creating XRP out of thin air, there's nothing you can do about that. You won't even know that happened. You will just think, oh, that's funny. Peter Todd seems to own a whole lot of XRP now.
And also, I haven't verified this because, again, I'm not a Ripple user, but I'm hearing lots of rumors how that the early Ripple transactions in the early days, they're gone. They're missing. Nobody can find them because no one seems to have the original history of the Ripple transactions.
That's not surprising at all. Like, the system just doesn't work that way. If you have that trust model, why would you download old transactions? Why would you keep them? You just throw them away.
But they're trying to work with within the current financial system. So doesn't the regulators require you to hold on to the history of transactions? If they're trying to be the currency for banks, there needs to be a mechanism. Unless again, Ripple is trying to outsource that
in a system
to
that
the
doesn't
banks,
scale. That's not really practical anyway. Like, your system doesn't scale. You being a bank, how are you going to make use of this if you have to have a full copy of every single transaction? Some tiny little bank in Iran
that you don't care about.
Yeah, right. But this just doesn't actually work.
And also, if you're holding those transactions and happen to be an Iranian bank, you can be held liable for holding transactions of a country who's on a banned list.
Yeah, that's
while at the same time being liable for transactions you may not have because they might need it in the future.
Yeah. Well, and after all, I mean, again, this gets back to the original Ripple concept. didn't have these kinds of issues because it didn't need global consensus. If the local laws were such that I could go send money to you and vice versa, and then you were allowed, because you're in a different country, to send money to a different country, but I couldn't send money to that country, there'd be no issue. I wouldn't need to have any of your data corresponding transactions that were illegal for me to do. And equally, I wouldn't have to spend all the money storing it. But, everything in one place, consensus, just adds lots of issues.
And and again, sticking with attack vectors, this I found just like mind-boggling. Like I would have never thought about this. Software backdoor, because currently Ripple Labs does not provide a secure way to download any of their software.
Yeah, I hate to say this, but the fact that you find that mind-boggling means you have more hope than I do. That's actually really common. Lots of security software just doesn't have a secure download mechanism. It's stupid. It shouldn't be true.
But how often does that software directly correlate with holding on to your money?
Often.
Really?
In the sense that, it may not be, say, Bitcoin wallet, but it might be software you'll load onto an OS with a Bitcoin wallet on it.
Well, what if we remove the world of digital bearer assets from the equation?
Big thing I'd just say is I put that in basically saying this is an example of the Ripple Labs team just not being very competent. It's not actually uncommon. And it's easy to fix.
I've seen that a lot in the crypto space.
They hadn't done it is just a bad sign.
I always say when I talk about this, like I came from traditional Wall Street, and when I was quitting Wall Street, I was like all about the crypto space. I'm like, I hated Wall Street as much as the next guy. And now that I've spent a few years in the crypto space, I fully realize how much more competent and the people were on Wall Street. And 99% of them are not crooks. They're people wanting to do a good job. And the developers are very competent. And I'm realizing...
Some of the time.
Relatively speaking.
It's funny because compared to many of the crypto developers, people on Wall Street are very competent.
Right.
But compared to the best in crypto, people on Wall Street are terrible.
Oh, of course. Yes.
And what that's really saying, I think, is the people on Wall Street don't have good enough security, but at least they do something.
Right.
At least they have standards they follow.
Right. And
the worst of the worst in crypto is just unregulated bullshit.
Oh, completely.
Whereas from the point of view of the good people in the crypto space, people on Wall Street, it's like, all you ever do is follow dumb standards that were out of date 20 years ago.
All right, so let's finish up with this section 5, and these are examples of the theft of validator secret keys. And you kick off this section by saying the attacker steals illegitimate control of the secret keys used by validators, particularly the validators in the default UNL, the unique node list. You also mention a closely related attack is the compromise of the Ripple website. The trick to trick people into downloading a default UNL list consisting of only the attacker-controlled nodes. Yeah. But again, this goes back to the security of not being able to properly download what you need.
Well, and I'd put it like the real-world analogy I'd give there is, if you're an armored car company and I ask you to make a cash delivery, there's two things that can go wrong there. One is you can go make a cash delivery to a vault, and I've stolen the keys to the vault. I've stolen the combo number and all that. And I can go in after hours and take all the money. The other one is I could intercept what bank you think you're supposed to go to in the first place. If I manage to trick you into sending the money off to the wrong bank, I'd just go take the whole thing.
Right.
And in Ripple Labs, where this really comes down to is, if I steal the keys for a consensus, I can create a different contradictory consensus. And those two consensuses at the cryptography level are indistinguishable. So, if I can attack your node, I can make you think that the consensus is something that it actually isn't. And once I do that, then I can go and steal money from you.
Right. And you to explain this, I'm going to try and read this a little bit faster, though my reading comprehension skills are not perfect. And this is exactly what Peter said, because he also wrote in the paper, and I'm going to try and read it a little faster than the previous reads. An attacker with the ability to create signatures from nodes on the UNL can create an entirely simulated ledger in parallel to the official Ripple ledger, containing any transactions the attacker wishes. In conjunction with Sybil attacking the target, the attacker can then perform double spend attacks. Sybil attacks are relatively cheap, requiring just the acquisition of a large number of IP addresses, example, via cloud hosting and or botnet rentals. In some situations, Sybil attacks can have zero cost.
Yeah, and you know what's interesting there is the fact that this attack is possible is made easier. Like doing this attack is made easier by the fact that Ripple tries to look like a decentralized system. You know, these Ripple Labs validators, the way that the consensus information is distributed is through a peer-to-peer network of untrusted nodes. Whereas if all they did was they had an HTTPS endpoint, in many situations that would actually be more secure. Given you're already trusting a centralized set of nodes anyway, it can actually be more secure to just connect directly to those nodes rather than to a peer-to-peer network, which can easily be Sybil attacked. You know, I mean, it can go either ways, but it's interesting that in some scenarios, putting this veneer of fake decentralization actually makes things worse.
That is definitely interesting. All right, one more section in here, and again, I'm going to try and read this a little bit quicker because we don't want to finish up very, very soon. The lack of incentive may invite coercion attacks. As the validators begin coerced into signing a simulated ledger, have no direct incentive not to. For instance, a court could order a validator to assist in a simulation attack on a target as a way of recovering funds held by the target. And then another bullet point is simultaneous attacks are made significantly easier by the fact that the Ripple Consensus Protocol will remove validators from the UNL if they appear to have failed. With the target Sybil attacked, the attacker can prevent the target from learning that the other validators have not failed. When those validators are removed from the UNL due to the simulated failure, the attacker does not need to compromise or coerce as many validators as before. Equally, if the target is using network split detection, the attacker can make the non-compromised validators actually fail as preparation for the attack. Again, the lack of incentive to run a validator is problematic.
Yeah. And I mean, quite simply, again, like this is another example where this thin veneer of decentralization hurts you. In a saner system, you just say, yeah, that's a UNL. If you don't get sign off by a majority of those nodes, you won't do anything. But Ripple tries to go make it, progress even in a consensus failure and a situation where nodes go down. And the very fact that they're willing to allow this, which is necessary in a decentralized system, it's the reason why in Bitcoin, hashing power is allowed to go down and the network will adjust. But in Ripple, that creates huge vulnerabilities because it is actually a centralized system behind the scenes. And you don't want to be in a position where you're actually split from part of those nodes.
Right. And because of what you just said for the Ripple system, I like how you snuck this sentence right in there during a nice long paragraph that basically says, Ripple Labs is happy to sell anyone the XRP to cover transaction fees because that's how they will make their money because they don't really care. They're just trying to make their position.
That sentence comes out of, I went and did an example, like story essentially of how an attack could happen. And all that's really saying as well, giving it a little hints, well, maybe this is what XRP is really for. It turns out, the XRP doesn't actually stop the attack. It has really no impact. Although it does make Ripple some money, which has some screwed up consensus. Screwed up incentives.
All right, so I'm just going to read your sentence of your conclusion. So section 7 is just the conclusion. And here's what you wrote. Nearly all the attack scenarios analyzed above are direct outcomes of the need for consensus. The actual blockchain technology that records the ledger is relatively uninteresting. So that was your conclusion of this paper, which I found incredibly interesting. It's not super technical at all. And even a non-computer science person that wants to understand how cryptocurrency works should be able to find that interesting.
It's kind of funny because I got criticized really heavily for this paper by Ripple Labs people and people in support of them. And a lot of the criticism came from the fact that I didn't try to analyze how the consensus algorithm worked, but I didn't need to. The paper was written assuming it worked, assuming everything Ripple said was correct, and saying, well, hang on a second, what assumptions are you making that you need this to work? And as an example, with Bitcoin itself, we assume that it's possible to buy ASICs on the open market. And to the extent that assumption is not true is a big problem with Bitcoin. And you could just as easily write a paper on Bitcoin saying, all right, we assume that, proof of work, all this stuff works. All right, let's go talk about what happens when you can't get an ASIC. And you could write a great paper on how broken Bitcoin was in that circumstance. You don't need to analyze the consensus algorithm to show it's broken.
And here's the interesting part, because you did a lot of research looking into their consensus mechanism. And if I was put in a position to analyze Ripple, I would have stopped after looking into Jeb McKenna and his history of how he came to Ripple. I would have had absolutely no need to look into the technology of Ripple. And I get criticized for that a lot, where people say, well, a lot of entrepreneurs fail the first time. That may be true. But when the entrepreneur scammed in his first project, that ends it for me. I'm not interested in his second project or his ability to do the second project. Because if his first project was a failure because of something malicious, the discussion ends.
Well, you see,
for me,
that paper was written for R3, and my counterparty at R3, who did the other half of the analysis, they looked into issues like that. And what ended up actually happening was, once this was all published, we actually gave a presentation, the two of us, Joe Lang and myself, to a large group of bankers in New York, really discussing this stuff. And I thought it was fascinating because between her and me, I think we really kind of opened their eyes to what Ripple actually was. And I found that the very simple explanations I had, really delving into details of, do these assumptions make sense, really resonated with people. And equally showing the history of how Ripple came to be, I'm sure resonated with some other people.
And look, I have to say, I have not been a fan of Ripple, but for years people ask me about Ripple, and all I can say is, I'm not a fan of it, but I knew nothing about it. Everything I'm presenting to you guys on this podcast today, everything that I just said, I learned all of this within the last 24 hours. You don't need a PhD or be an expert in blockchains like Peter Todd or Gregory Maxwell to have an enormously better understanding of some of these projects in the crypto space. All you need is to just devote one day. And I didn't spend full 24 hours. I mean, I did get sleep, I did have food, and I did hang out in Toronto with great people. But this is what I've done just over the last 24 hours on my free time looking into this. And it was like my eyes are now wide open on what Ripple is. And I will be able to discuss Ripple much better next time somebody tells me their company is interested in Ripple. And I will be able to just send them this video. All right, so let's conclude about the future of Ripple, if there is any. But clearly, we've already discussed the person that was basically the lead cause of how Ripple looks today. He's already exited MtGox. He's already exited Ripple itself. He's now on Stellar, assuming he's still there and hasn't fully exited that position. You can't take the tokens back. You can't put the genie back in the bottle and remove these XRP tokens to go back to what Ripple originally was, that I bet, at least some of those co-founders might be thinking about, because there might be some legal liability coming down the line.
I would actually describe it a little differently. XRP doesn't have a clear need. The Ripple system doesn't have a clear need for XRP. Simple as that.
Yeah,
You know,
because
so if you're not a big bank deciding whether or not to integrate Ripple into your system, you got to ask yourself, why the heck would I own XRP? You know, if like I was deciding whether or not I'm going to go buy XRP, the question I should have is, well, why would it maintain value in the future? And there's just not a clear need for it in the Ripple system.
Right.
It makes the system a lot more complex.
So I have
lot less
so
interesting.
here's a politically correct question to close us off. Is this entire project just totally fucked?
Well, so the interesting thing about that is Ripple themselves, I think, kind of answer that. Because their next big project, sort of on top of Ripple, but also on top of other systems, is their, what they call, interledger protocol. The whole purpose of interledger is to do payment channels between different ledgers.
How is interledger another word for hyperledger, or are they completely different?
Very different than Hyperledger. It is, however, similar to Lightning and uses similar techniques. And the big thing with Interledger is it's getting rid of the need for XRP even more strongly.
And they're in support of this, Ripple Labs.
They're quite in support of it. And from the point of view of the company, I can't blame them. You know, Interledger is probably decent tech.
But hey, if Ripple Labs has made sufficient profit in Bitcoin or fiat from selling that 30 billion Ripple tokens, which at one point were valued way, way higher, not to mention the founders, clearly, at least one of them, Jeb McKenna, was able to sell some of his tokens to make money, and then he was able to split that project and duplicate it into Stellar, where he probably also made money, because that also has some kind of a monetary value. But on that note, I guess this is a good way to end it. And if you have anything else to add, I think we've gone through our views and thoughts of Ripple from start to finish. Of course, I apologize for any mistakes that have been made, but this is my view of Ripple after approximately 24 hours of deciding to do it while in the presence of Peter Todd here. So thank you very much for helping me out with this.
Thanks for having me on.
All right. On that note, we will sign off. And why don't you tell people where they can reach you and how they can find you online?
Well, at Peter Todd BTC on Twitter, and Pete at petertodd.org on email.
And I am Tone Vase. My blog is Liberty Life Trail. Of course, you know this podcast, CryptoScam. I also do a weekly video about markets and trading and technical analysis. I am Tone Vase on Twitter. And watch out for me speaking in your country or your city sometime soon, because I'm still making the rounds around the world. Thank you so much for tuning in. And please watch the next episode of CryptoScam. Subscribe, leave comments, thumbs up, thumbs down if you like this. If you don't like it, that really helps to go around the web and also catch us on SoundCloud.